with offering you guys a live stream for this week. We just had the best week in the stock market that we've had in the last 3 months. So anybody who's really kind of taken up investing in the last month or so is probably getting the other side of the coin that the stock market has to offer. Some of the new investors that are kind of dabbling their feet, getting positions started, getting portfolios built out in the stock market, I do applaud you. All right. I'm going to be talking a little bit about buying into strength in the near future here. As I'm kind of taking a little bit more of a defensive posture while everybody else is enjoying a euphoric state right now with the stock market just going to the moon. Stock markets do go up and they also go down. I've got some incredible announcements to make during this live feed. If there's anybody out there that's actually new to the live feed, I'm going to allow some of the group to get in here. This is really just your guys' opportunity to kind of pulse in and kind of spark up a community discussion about the stock market. Why? Why do we speak so openly about the stock market? It's really one of those things that I feel like everybody should participate in some way or another in the stock market. But I do think that there's a lot of new people getting involved in the stock market, definitely from coming across my channel, getting excited about the prospects of investing in the stock market. But it's always nice to have that, that person that you can kind of bounce an idea off of. And if you have a question out there, if you're new to the subscriber base here, throw your question out there to the community. Well, I'll do the very best I can do to get to you. I'm actually probably going to maybe offer up a Saturday live stream this weekend as well. I'm going to kind of test it. I've had some of my subscribers kind of talk about maybe Saturday being a better day. So I may do both days, whatever is valuable for you guys. It's really nice to hear a lot of different opinions about the stock market, and it allows you to kind of get mine, kind of pulse in with me from week to week on what's going on, kind of the breadth of the market, what's kind of going on right now is the G7 summit in Canada, which is actually very big. We've got all the world leaders from all of the respective countries there. Germany, France, England, US, of course, is up there. I've got Lee Nguyen says I'm the best channel ever. Yeah. Well, listen, I don't wear a suit and I don't put on makeup for this. Okay. I just think there's way too much smoke screen in the world now. And I think that it's kind of refreshing to have a guy like me come on here and just really kind of talk real about, what I do in the stock market. I'm definitely not free of mistakes. I do not forecast where the stock market going. We have a general discussion about, where the stock market is, how we did in the week, moves that I've made actually this week in the stock market. I try to be as open with you guys as I can to keep you guys kind of pulsed up. But just to kind of get things started, I want you guys to kind of think about a perspective a little bit. And here it is. If you took a scenario and you took 10 investors and you put them all in the same camp and you gave each individual investor $100 to invest in one particular stock, and I'm the one that chose the stock. And let's say, for example's sake, each of those 10 people were given $100 and they were allowed to invest in Apple computers. All right. The ironic part that people really need to understand is that you would think because the dollar is controlled and the stock is controlled, that the results of those 10 investors would be exactly the same. And I contend that we really need to change our way of thinking. And I actually contend that the results of those 10 different investors would actually all be different based on the free will that we have in the stock market to work really, really hard to make a stock trade bad, or to work really, really hard and make a stock trade positive. Okay. So what I mean by that is you've got 10 investors, and I contend that even though they're the exact same investment, each of those 10 investors are going to actually act upon that investment differently. Okay. Some are going to hold it forever. Okay. Some are going to hold after a month. Some are going to hold after 6 months. Some are going to hold after a year. Some are going to take it into a downturn, sell and lose money. Some are going to take it into a downturn and keep it and not invest more. Some are going to take it into a downturn and not dollar cost average. They're going to set up the account investment, and they're not going to set up a dollar cost average or a dividend reinvestment program into those. So you guys see how many different outcomes you can have with the exact same dollar amount and the exact same investment. And I found that was a really, really intriguing way of thinking about the stock market, is working really, really hard to put yourself in the right account, the right stock, and then working really, really hard to make even a negative trade a good trade. All right. Now, I just went through this with Facebook. All right. When Mark Zuckerberg was on the Hill in front of the Intelligence Committee doing his testimony, all right, I could have panicked and got out of the stock. I did not do that. I actually bought more when the stock was down, and I made it a positive trade. All right. Now, I backed off of Facebook a little bit in the mid 190s this week, and I actually picked up another 10 share small position to put myself at a 30 share position. All right. Now, when the stock was at $150, all right, I had 80 shares in the company. All right. I liquidated the first 30 shares because it had run up so well. I had done really, really well. And then I liquidated another 20 shares on top of that, made a $1,700 profit. Now I was in the whole $1,700. All right. So just give you kind of an idea about when you invest in the stock market, you have to be willing to own your holdings into a downturn. All right. Now, I've got some really, really good news for the group here. And for you guys that are just making their way into the group, I've really got some killer questions coming in. I'm going to start up here with these questions and start kind of knocking these out kind of in sequential order for you guys. Because that's really why we do this. But I do have an announcement for you guys, and I want it to come within the first 10 minutes of this live stream. I actually traveled to upstate New York this week. I actually visited a good friend of mine, Ryan Scribner. He has a channel on YouTube. He's got he's going to be closing on 250,000 subscribers here pretty quick. And he allowed me the pleasure of doing a joint video with him. It's going to be 6 dividend stocks. Which is a really popular video on YouTube. So if you guys actually, please stand by for rolls, because if you guys see a big bomb go off on the Independent Investor channel, that's probably why. Because he has been gracious enough to allow me to come on to his channel. I'm the one that does the video. We actually shot it at his kitchen table. It was perfectly fine. And we sat there and we basically wrapped stocks for 20 minutes, man. And I'm very happy with the content. I'm very happy with the way that the video went down. I was able to kind of portray my perspective on the stock market a little bit. And hopefully people really respond positively to that message, because I really tried to differentiate between what a lot of people pursue in the sexy stocks. Everybody wants to get involved in Facebook, Google, Nvidia, Netflix, right? Because those are the high flyers. Those are the ones that are making people a ton of money right now. And I think you guys are fine. When this video is released midstream next week, I think, I really want you guys to keep your eyes open for that. And I would ask for your support when that does hit the mainstream and you guys see that coming across. If you guys can share that video with your networks of people, I would really like to see the Independent Investor channel really start to kind of grow. And I actually am anticipating getting close to 10,000 subscribers based on this exposure that he's been so kind as to provide me with. I really just enjoy hanging out with him. He was actually able to show me his new place up there, walk around the marina there. He kind of showed me some of the amenities of the apartment he had, but just a genuine guy, no doubt about it. I'm just sold, and I'm really encouraged that he would actually take it upon himself to actually allow me to do that on his channel. He was glad to do it. He really was. And I'm so grateful for him for that opportunity. But I would ask of you guys, please, to keep your eye open for that. I'm excited for this delivery. I was excited for the topic. I studied very hard for this video so I could really deliver, not only 6 stock picks, okay, because anybody can do that. But I really wanted to deliver it with my twist. My intent and really reaching new investors to get started in the stock market in the correct way. Okay, so please keep your eyes open for that. And if you do come across that video, do not hesitate to take a look. Hopefully you enjoy it, but also share it with anybody out there. That'll really help, I think, kind of push out the message of the channel, and really kind of exploit the nerve of independent investing or individual investing, self-directed investing, and kind of, how we go about taking a mindset of self-directed investing and deploying it for yourself in the stock market. It's really, really important, guys. So I'm going to kind of hit some of the community guys up here. You guys are in here. Really, I appreciate you. I don't thank you guys enough for coming on here and supporting the Friday live stream. I really think it provides really good visibility to the channel. And honestly, if I was watching a channel and I felt disconnected from the creator, I wouldn't waste my time. I really wouldn't. So hopefully this provides you guys a little bit of connection to the person that's actually trying to put out the message there. And you guys can kind of get your questions answered by me. So what do you recommend to open? What company do you recommend to open a self-directed IRA? That's from Sean. That's the first question of the night. I've had a few people actually DM me, actually asking me that very same question. And it's a really good question. And I'm so glad you asked it. Everybody who's been tuning in to me, I'm very open and vocal about my brokerage with Merrill Edge. They were one of the first brokerages to offer self-directed programs some 7 years ago. And as a matter of fact, they cold called me, and I typically don't answer my cell phone. For some reason or another, I picked up my phone that night, and there was an agent on the other end of the line, really kind, explaining what the program was all about. And it just so happened to be at an impasse in my investing career where I was really looking to make the move. I just didn't know what was available, what was out there. My brother had turned me on to that option just a couple days before I had received the cold call. So I was actually going to go on to Bank of America and search this out. This was around the time that they actually took and acquired Merrill Lynch, right? We all know the bull, right? Bank of America took ownership of that company, and Merrill Edge was born, and that's the brokerage house that offers self-directed. Now, I really want to premise this because I really do offer my top 5 brokerage houses all the time and openly, and that's TD Ameritrade, Fidelity, Charles Schwab, Vanguard, Merrill Edge is up there, and there's a few more that you can use. USAA does offer a self-directed account, but you have to be kind of careful when you call some of these brokerages, and they will try to upsell you on a managed situation. So you really have to stick to your guns and understand and validate why it is you're opting to a self-directed account, okay? Because they may try to talk you out of it. Remember, they don't make any money off you in a self-directed account, okay? Minus some trading incentive there, but that's really not worth it. They want to attach management fees to the account. And the only way they can do that is if you agree to the fee structure. And if you basically, by going with a self-directed account, you are opting out of the fee structure that they offer. So it's a big, big deal. All right. Now, in each of those recommended brokerage houses that I throw out there, I do not throw those out there lightly. I've got the Financial Information Channel, who also offers M1, very highly recommended. Some folks have went with Ally Bank. I've heard positive about Ally, and of course Vanguard, but Vanguard really isn't really geared toward trading stock. They're more of a passive product offerer, okay? But they do have a self-directed account, and if you have other accounts, let's say a 401k with Vanguard, certainly I always try to advocate for keeping all of your accounts on the same page for just the sheer sake of visibility, okay? You want to be able to open the screen and see all of your accounts on the same page. That way you can link up your savings, maybe your checking, or at least one funding source, so you can easily transfer funds into the money market account, which is the brokerage account. That's going to be the holding account before those funds are deployed into the self-directed account, okay? So it goes from savings account, which is your primary bank, and then it's going to transfer over into the brokerage account. And within that brokerage account, you're going to have your account, your money market account. And that money market account basically is a super low interest rate, and it's going to sit there until you tell those offerings where to go in that stock portfolio under that self-directed umbrella, okay? So that's kind of how that works. Now, The difference between the brokerage houses, you're going to get a few dollar variance in the entry fee, the stock sale and entry fee. Now, if you have $0 to $10,000, I highly encourage you not to look at getting interested in constantly trading in and out of stock, okay? If you have $0 to $10,000, I highly encourage you to look at a good passive base. And if you want to add some single stock exposure to it, you absolutely can, all right? But don't look at the stock market as some place that you're going to try to time or pick stocks and sell out of everything constantly, because from $0 to $10,000, you're trying to accumulate wealth. You're trying to accumulate a nice share balance within that portfolio, all right? And the last thing I will say about portfolio or brokerage houses is that when you're choosing your brokerage house, really what you're doing when you're opting for a self-directed account, and each of those brokerage houses offer that, all you're doing is seeking your entry, your direct entry to the market. Now, what you're buying when you're choosing between a TD Ameritrade and a Fidelity is really just the aesthetics of the platform, okay? Now, I give you this opinion based on a lot of different opinions I get reciprocated back to me from my subscriber base, okay? So I don't mind turning that information back to you for your own value, okay? Does that make sense? All right, so remember, each of the accounts that you're going to get offered are going to be offered through each of the brokerage houses. It's not going to matter, right? But the aesthetics in my Merrill Edge account are going to be different than the aesthetics of a TD Ameritrade account, right? And so basically what it comes down to is, do they offer a self-directed account? Yes. Are they tied to or close to your primary banking source? Try to do that. It really helps. And number three, it's really just the aesthetics of what you choose and what type of functionality you want within that account, all right? And those are really the top 5 that I can give you just off the cuff, all right? So thank you for that question, Sean. I've got K97 right below. JD is going through the roof. They are about to be listed on the Chinese stock market, Chinese depository receipt. They have a big sale festival going on now called 618, going up huge long term. K97, I agree with that. I really do. I will give you guys some insight on some of my stock moves this week. With the stock market kind of going on a tear this week, it actually gave me some position power to take a little bit off the table, all right? Now, where it might be appropriate for me to take some profit off the table, it may not be suitable for you guys. I know some of you guys are probably looking at the VOO or the BTI or some of your single stocks right here, and you're sitting on a little bit of profit, okay? Get used to that, all right? But don't get too used to it. Okay, because stock markets go up and they also go down, all right? And if you've been investing in the stock market for a couple months, don't think for a second that you've got this thing licked, all right? Be realistic with your expectations. Do not be surprised at all to see the stock market go down next week, okay? I have a very big concern that I will put out there to the group right now. And that concern is with tariffs, okay? I kind of think that we're missing the mark a little bit with this tariff, and I hope that it remains in discussionary phase. But I really believe that a lot of countries impose tariffs on other countries to protect their own interest, all right? It's not necessarily to punish imports. And that's basically the way it's being portrayed over the news media, except for a few. A few people will get on there and actually talk about, you know, a tariff that Canada puts on, let's say, for example, U.S. pork imports, right? They're flushing that market up there. So they can't just flood the market with U.S. pork. So to try to level out or equalize the market up there, yes, there's a 300% tariff on that particular commodity, right? But they have to do that because they don't need the commodity up there. It's a very strong market and they're flooded with it. And if they didn't do that, they would have a bunch of cheap pork from the US hitting the Canadian market. It's not that they don't like us. They like us. Okay. I just really hope we're seeing a grander picture in all this and really kind of making sure that by playing with the dialogue of trade war, guys, if we enter into what is going to be a declared trade war, we're going to have a problem in the stock market. Okay. So I really want you to keep a couple things in mind. Be defensive. Okay. Be optimistic. Okay. That's fine. But I want you to be consciously optimistic. Okay. Now, What do we do now as far as buying into strength? I highly recommend that you don't take, if you're, again, in the $0 to $10,000 camp, invest away. You're fine. All right. You can take a 30, 40% haircut on your money and you will be fine long term. All right. You may be mad at me for getting you in the stock market, but you cannot judge me over a couple months of a downturn in the stock market if in fact that happens, okay? I could be completely wrong and the stock market could continue to go on fire, all right, for the foreseeable future. Perhaps the tariff talk goes away. Perhaps the tariff talk actually makes a lot of progress with a lot of countries, because I use Canada as an example. Canada is a really good example. I think China is an actually very poor example, because it's not just the reciprocation and trade that we're talking about. We're also talking about intellectual property theft from China as well. That's even bigger of a problem, all right? I think the tariff talk can get taken care of, but I really think, I really hope that the trade talks remain trade talks, because if we enter into a full-on trade war, we are going to see a downturn in the stock market. And there were some folks today on CNBC talking about it shouldn't affect the stock market at all. I completely disagree. If we enter into a trade war, we're going to be building cash reserves, and we are going to be holding stock, and we're going to be holding on for a ride south. All right. So make no mistake about it. I'm not one of these guys that come onto YouTube and talk about everything in the stock market is doom and gloom. Okay. And right now, we are in the state of euphoria in the stock market. I've never seen it like this before. And this is where, while everybody else is dancing in the street, all right, this is where I'm taking a little bit more of a conscious position, all right, trying to shore up some positions in some of the profit that I have, and maybe rolling them into some of those blue chip safe stocks that we all know of and love, all right? Now might be a time to do that, or now might be a time to allow your investments to ride going forward and start to stockpile that cash, okay? Start to stockpile that cash on the side, all right? I've got Michael on the line here. You rock, Ryan. Well, I'm not playing guitar right now, Michael, but thank you. I really appreciate that. I have a question about investing in stocks and ETFs. I know they say the rule of thumb to never have more than 5% in one name. Is there such a thing as being too thin? Yes, there is, but I want to premise this. Look, if you guys, again, I hate to just bracket people, okay? But I talk about investing goals 0 to 1,000, 0 to 5, 0 to 10, whatever makes sense to you guys. I don't care. Make a goal to get up to wherever you're at. If you have zero investment capital in the stock market, you have no idea of how. I hate to even use the word investing with new investors. Just call it, become a participant. Okay, pledge a certain percentage of your dollars to become a participant in the stock market. But I've had a few really loyal subscribers come back to me, and they've got $6,000 invested in the stock market, and they own 47 stocks. Okay, that's a real scenario. And I don't throw that out there to embarrass this individual, because he's not the only one. He's not. Most everybody looks at the entire landscape and they want to own everything under the sun. And it's so much simpler than that when you start investing. If you have $0 to $10,000 in investment capital, I will deal with the first 0 to 5,000 first. Okay, $0 to $5,000, you could probably own half of that $5,000, $2,500 in a passive investment vehicle, an ETF, for example. The remaining $2,500, you get 2 stocks. 2. If you wanted to add a third, you could probably do that. I will award you the third pick only because you have closer to $5,000 and not closer to $2,500, okay? Now, if you're looking at the $5,000 to $10,000 realm, we want to bump that passive envelope up to probably half. You could probably do a full $5,000 in the passive ETF round. And if you wanted to bump up the single stock exposure to maybe 3, 4, or even 5, depending, okay? And that is a big depending. All right, that last $5,000, the majority of that money is going to be held in the major sectors. Technology, number 1. Number 2 right now is financials, okay? Number 3 is going to be healthcare, and number 4 is going to be industrials, okay? So that's 4 stock picks right there out of those sectors. Now, number 5, you're going to have to pick between a discretionary and a staples before we move on to energy, before we move on to materials, before we move on to, what else am I missing? We got energy, healthcare, telecom. Good grief. Telecom is absolutely hated right now. But if you wanted to add, let's say, another smaller position out of that $5,000, I would go ahead and advocate for a 10-share position in Verizon if that's really, really what you want, but not at the expense of these 5 primary sectors. And it starts with technology. Technology is by far and away my favorite. There's so many good buys right now in technology. You guys could come back to me and say, Ryan, give me one good example of a technology exposure that's going to give me great dividend growth going forward. I'm going to hit you up with Cisco. I'm going to hit you up with Intel. I'm going to hit you up with Apple. And I'm going to hit you up with Microsoft. And what's another technology? You could probably throw Oracle in there, but you could probably take that 5th and do a nice growth name as well. With $10,000, you've got some pretty good position power, maybe to add a Facebook or a Google in that account. If you ask me about that, I would say absolutely, that's a great move. But technology is that most important one, all right? You can absolutely become too watered down on one side of the house. But when you say that rule of thumb is never own more than 5% in one name, I abide by that rule. I think the only rule that I break in that category is Google. I think I'm around 6%. 6.5%, I believe, if I'm remembering correctly, in Google. All right. But single stock exposure, it's impossible to fully diversify in a single stock portfolio. That's another reason why I highly recommend that if you guys have an existing 401k with your employer and you use the self-directed account as kind of the top of the iceberg, right, then you can allocate more single stock exposure up here while you've got your diversified passive base down here in your 401k, all right? But if you're working with strictly a self-directed account, totally fine. But you're going to have to build everything within that self-directed account, and it's going to take you a little bit more time to do so, all right? You guys that are sitting out there with employee-sponsored employee funds, it really does put you in the driver's seat to enter into a self-directed account and be just a little bit more aggressive with that stock exposure over there. Whereas you might not want to add so much to a passive in the self-directed because you've already got that built. Okay. You can afford to enter into some of those really good blue chips within the self-directed, maybe some good dividend payers, right? Because when I want to get you guys started, if you guys are in the $0 to $10,000 camp, I preach the same thing. I'm preaching the same stocks. I didn't even have time to hardly recommend Procter & Gamble to you guys before it just went on its tear this week. It's been on an absolute tear. You guys could have picked up on Procter & Gamble in the low 70s. And when everybody's talking trash about the stock, that's when you want to step in and pick up a good quality company. The other one that I will mention that's even better than Procter & Gamble right now is Johnson & Johnson. Johnson & Johnson is giving you guys an absolutely phenomenal entry point. And if you didn't look at any other name in the healthcare sector and you do not have Johnson & Johnson in your portfolio, it's absolutely one of the best buys right now, getting an actual beat down in the on the street for no real good reason. Nobody knows why. And they're a fantastic business. That's a great question. Thank you, Michael. Question on wash sale. Does that pertain to the Roth self-directed as well? No, it does not. If you were to sell an ETF stock or mutual fund, do I have to wait at least 30 days if I want to buy it again? No, sir, you do not. I haven't traded mutual funds for quite some time. I think mutual funds are a pain in the ass, to be honest with you. They settle out after hours. Even when you buy the mutual fund, I don't even know what the hell price I'm buying it at. And that's the beauty of ETFs. And ETFs really do trade like stock. And that's one thing I really like about it. I actually reduced some of my position in VOO. So if you guys want to jump through the computer screen and choke me, you certainly can. But I'm very visible with my moves. The reason why I did that is very, very simple. I had a $25,000 block in VOO. So it's different if you guys are carrying a 5 or even a 10 share position in VOO. The prudent move for you guys could be to hold that stock. I just recommended exercise my right to sell the stock and take some position power in what I feel like is a higher market. Okay, that's just what I chose to do. All right. So to give you guys some level of visibility, when I'm managing that much money, and when you hold 100 shares of VOO and you've got that big of a position and the market runs up as much as it does, right? That's something that I look at very, very carefully, right? So could I hold it long term? Certainly I could. Could it be a bad move to liquidate some of that position back? Yes, it could be. All right. But I have a very good pulse of where the stock market is. And the fact that I already have an existing S&P 500 index fund with my work, right? Then I can justify taking that strong position in the ETF and maybe selling out of it when I get a good solid market. Now, when I bought into VOO, the market adjusted back big time. I mean, I think I was down close to $1,000 in the ETF. And when you own 100 shares of it and it goes down that quick, I mean, I think I got into it at 250. I think it pulled back $10 a share. I mean, it was that quick. Boom, I was down $1,000. Did I panic? No, not in the least bit. I've just got long the shares. I just made up that $1,000 and I went into the positive a little bit and took a nice bit of profit in VOO. But you're going to start to put yourself in those position powers to where you can leverage the stock market in a way to where you win no matter what. All right. And that is the beauty. The bad part about going to Las Vegas and playing a blackjack hand is you don't get to play that hand again. All right. Once you lose, you're done. You're lost. The stock market is a beautiful place where you can invest your money and you can actually cash in your chips when you choose to do so. And that comes back to my example about the 10 different investors all investing $100 into Apple and all coming out with a different result. You have to be mentally tough in the stock market, and you have to be willing to take these good positive assets into a downturn, okay? We do not panic in the stock market. And in VOO, what I actually did when it went down is actually started accumulating shares. I accumulated shares until it just swung back this week, until it got to a position where I was happy taking a nice block of profit and putting it on the sideline in cash. I basically went from about 3 or 4% cash to a pretty good amount of cash on the side. I think I'm back to 20% actually. Moved a good block of cash aside. That doesn't mean that my long holdings still don't exist. They do. I own my long holdings. I actually added some additional positions in some of my long holdings. If you guys are interested in an extremely good blue chip company, you guys need to look at Pepsi right here. All right. You guys want to pick up a good position in a fantastic dividend paying company. Pepsi is right for the picking right here. So you could definitely look at that stock right here. So this is an awesome question. You can basically, the rule of thumb is you can maneuver and do whatever you want within your Roth IRA as much as you want. It does not matter. It does not matter. That's an awesome question. I got Greenhorn Grill and Smoker, my restaurant owner. That's awesome. That's going to be my brew pub and smoked rib house someday, man. Greenhorn Grill and Smoker. That's just a killer name, man. Also Chinese, Netflix, YouTube, ticker, IQ. It's going to be up huge last 4 weeks, waiting to have waste management to go down a little to get a little bit more. I think you're okay with waste management going and buying it right here. I think you're good. Maybe with the Fed interest rates meeting next week. That was another looming reason why I just decided to go ahead and pull some money out of the stock market. You guys can remember, listen, the trades that I made today, I think I made 9 trades today. All right. I trade for free. And that's eventually where you guys will be down the road. If you guys want to take $100 profit off of a trade, you're going to get to do that. And you're going to get to do it for free. You're not going to be subject to a $6 or a $7 entry and exit fee on the stock, because in my particular brokerage house, the incentives that kick in right at about $50,000. All right. So if you have $50,000 of combined assets within Bank of America / Merrill Edge, they're going to give you those incentive benefits, and it kicks in at $50,000. You get 30 free trades. All right. When the incentives kick in at $100,000, you get basically unlimited. You get 100 free, but that's basically unlimited because I never, ever use 100 free trades a month. What the hell am I going to do with 100 free trades? If I could give them away to you guys, I would, but I can't. Okay. But the reason why I offer this information to you, kind of back up to my very first question, is talking about some of these brokerage houses and knowing what questions to ask of these brokerage houses when you're calling them on the phone. What type of incentive thresholds do you need to be at for me to become a player with you guys? Is it 50,000? When I ask the question of Vanguard, the incentives kick in at 500,000 for reduced trades. You have to have $1 million with Vanguard to enjoy the exact same benefits that I enjoy with Merrill Edge at over $100,000. All right. So just little things to kind of keep in mind, and things that you can keep in mind and not get this information unless you're tuning into the Independent Investor channel every week for the live feed, man. We're full of good information and we're pushing out there for your guys' benefit. All right. There's some killer questions, man. Very, very cool. Just be kind of careful with the Chinese stocks, guys. There's no better place. And I hope some of my investors around the world don't get offended by this, but the United States is a place that you have to be invested, okay? It's the regulatory oversight on our markets. Quite frankly, I trust them. I don't necessarily trust the Chinese stocks. I don't. Sorry, I don't. The Chinese government can step in and they can control anything that they do. They do it with a few stocks that I've owned before. I still own China Mobile. And that stock, there's no reason why that stock should be going down. No way. It's the largest cell phone provider in the world, and their financial stewardship is poor. It's poor for a reason. It's poor because the Chinese government controls exactly how much of the payout goes to shareholders, and they do not care about a minority shareholder in the U.S. getting paid their dividend. They could care less, all right? They don't. Their stewardship should be at about 70% payout. I believe it's around 40. It's nice to know that I'm doing my part to contribute to growing the Chinese government. So we're going to try our best to keep this under an hour today, guys. I've got a really good group in here. Hopefully we can kind of make it through all these questions here. Any views on Fannie Mae? Have heard it could be great at $1.50 long term. I'm going to look at that. I think you hit me up with Fannie Mae. I thought sometime this week. I'm talking about K97. I'm actually going to look at that. I may take a speculative play on Fannie Mae. Why not? At $1.50 long? No, that might be an easy doubler right there. If you guys have some speculative cash you want to put to work and you're young enough and you don't get overzealous because that's really hard to duplicate, take a little stab at it. Try to double your money. I mean, 150, 100 shares, 150 bucks, good grief. I mean, you double up and you're at 300 and, maybe you buy a couple hundred or 300 or 500 shares. Now you're talking a nice double up there. So yeah, I recommend that move. Just don't get into a habit of doing that exclusively, and especially at the expense of good blue chip investing. All right. You always want to make sure that you're building up your blue chip, your blue collar stocks first, or your blue chip stocks first before you start allocating a little bit to a speculative play. All right. I've got Sarah on the line here. Justin's asking, how am I? I'm really, really good. But Sarah's on the line with a question here. A friend of mine is close to retirement and she has saved cash in the bank. Okay. Is close to retirement and she has saved cash in the bank. She has a 401k. She is wondering about a Roth and some conservative investments for the next few years. Any ideas? Absolutely. I actually had somebody, Sarah, hit me up this week with kind of a similar question. And I actually called him directly. And actually, he's right below in the comment. I see one of my good friends here right below Sarah. So listen, I'm going to address Sarah's question, and then I'm going to get to my good friend Les, who's right here in the group, who's probably wanting to get to work, I guess. It's pretty cool. I'm surprised to see Les in here. Very cool. But I love sharing that information. And sometimes that's really what it takes. It's really hard to take a couple sentences and offer, a broad portfolio. It's very possible. Okay. And it's definitely possible. I love the challenge of doing that. But here's what I would say. If she has a 401k, I would really kind of need to understand if we're talking about a $50,000 401k or a $500,000 401k or a $10,000 401k. All right. That is going to, and you don't have to tell me in the group. Okay. But I want to give you some of the challenges of answering this question a little with some of the broad details. Okay. If she has a 401k, she definitely needs to get something going with a self-directed account, okay? Anybody can do it. It's fine. It's a benefit to you to do that. Some conservative, long-term passive investments I've already mentioned in the group, and I will mention these for your friend, all right? If you're interested in some beautiful, long-term, blue chip, dividend-paying stocks, you are not getting a better entry point on these few stocks, all right? And I'm going to name them for you now. And if you want to write them down, you certainly can, all right? Johnson & Johnson, number one. It's my number one buy right now. It does not get any better, all right? Number two, Procter & Gamble, all right? These two stocks right here are on my list of stocks that you can buy and you can own forever. You can own them forever, all right? Those are two stocks out of two different sectors, right? Because we're trying to get different sector allocation, okay? Number three, and you guys may disagree with this, but tell your friend if she would like to invest in a $250 billion market cap bank, Wells Fargo is where it's at, all right? Now, I understand about the account scandal, all right? I get it. Were they beat up justifiably? Yes, they were. They absolutely were. I do not appreciate predatory lending on a customer that walks in and has no idea that they don't need 7 accounts for themselves, and they're sold on just that, all right? Because I contend that anybody just needs a checking and a savings account. And I also contend that people, if they're resourceful enough, should get that information free of charge, all right? They should get those services free. Never pay a bank a dime, ever. If you're going to pay the bank a dime, go ahead and go down the street to the next bank, all right? And they will gladly accept your business, all right? Because they're taking any of your deposits and they're investing it into the stock market, all right? Wells Fargo, number three, all right? If your friend is really interested in the technology sector, I've named a few of those offerings here and now today. But certainly, you could not go wrong with Cisco Systems. You cannot go wrong with Intel. You cannot go wrong with Apple computers. You can't, all right? So those are some of the conservative plays that I would encourage your friend to look at. The last one probably being Pepsi, all right? And then I would also look at Disney. All right, that's about as good as it gets. And I don't want to give you any more, because if I thought that your friend was sitting on a $500,000 401k, certainly we could build a stock portfolio in excess of 10 stocks, right? We could definitely do 10 or 15. But relative to the size of that 401k, we want to make sure that the holdings are not watered down. We want to make sure that those holdings are not top heavy to stock exposure. We want to make sure that they are reflective of a good, sound portfolio. And that's at the expense of some other sectors. All right. I didn't recommend telecom. I didn't recommend utilities. And I didn't even recommend industrials for your friend. Okay. Because the only industrial name that I would recommend to your friend is United Technologies right here. Okay. That's it. So I hope that helps. If you need any further information, Sarah, do not hesitate, please, to reach out to me directly, and we can talk further. But you can't go wrong on those picks that I gave you. There's a few honorable mentions I could throw in there too. Walmart is an absolutely phenomenal buy point right here. You're not going to get it in the low 80s. I think it's in the mid 80s right now. You're not going to get it this low for very long. Okay, so if you want to enter into Walmart, you can certainly do that right here, okay? But turn your friend onto the channel. Certainly, I give you more information than you could ever need in the stock market. We look to dispel a lot of notions in the stock market that people can't do the stock market. It's made out to be some mystical place that nobody can participate in, and it's wrong. It's wrong. It's not that it's my opinion that it's wrong. It's just freaking wrong, all right? It's just wrong to teach people that type of thing. And that's really the message that they want to put across to people. I just don't get it. It's crazy, because I'm a testament to somebody who is not the sharpest tool in the shed, guys. Trust me, I'm not. I've made every mistake in the book. All right. If you could find even half of the success in the stock market, right, by just avoiding some of the mistakes that I've made, you would make out so much more better in the future by not opting into a financial situation. And that's really what they will have you to believe, is that you need to seek the services of a middleman. And you don't. You don't. Cut all that out. Provide yourself direct access to the market. Come to the Independent Investor channel. Hell, I can provide you 100 stock picks if that's what you want. But like I told Les this week, which I'm going to get to his question next, all right, I told Les that portfolio building is the fun part about it. It's fun, all right? It's getting people into the mental conditioning of looking at the numbers and saying, you know what, I can do this, right, Les? It's looking at that particular thing, starting the right account, buying into that idea of investing on your own, getting people to bridge that gap between going from, oh my God, I'm a scared puppy dog, right, to I'm a raging bull. And you got to take the stock market, man, and you got to grab it. And you got to say, you know what, I can succeed in the stock market. And this kind of is a good premise to a new series that I'm going to be coming out with, all right, which talks about succeeding in the stock market by not thinking about the stock market at all, by pushing other buttons of success in your life over here: dietary, spiritual health, physical health, right? Relationship health. By pushing all these buttons over here, you would be amazed at how these buttons over here, if you push them all and you're consistently working on all these over here, it's going to affect that financial health over here. And you may think I'm crazy. I'm absolutely not. Because here's the thing. If you fail at every single one of these other aspects, and I see this all the time, people can't keep a budget and they come to me and they want a magic portfolio to satisfy some deficiencies on this side of the house. They can't keep a budget. They can't, keep a diet, right? They can't exercise. They can't do anything over here on this side of the house. And they expect that somehow investing in the stock market is going to somehow save this over here. And that's just not going to happen. It's not going to happen. Thank you, Sarah. Appreciate the question. How much of the portfolio should be in ETFs, VTI? I've got Baba right below Sarah, and then I'm going to get to Les's question. I do see Average Joe in the house, so I'd like to welcome Dave. Average Joe is a channel creator, and I would like everybody in this community to go ahead and click over to his channel and subscribe. I love when Dave's in here, man. Hasn't been on for the last couple weeks, man, but I always acknowledge the channel creators when they come out here and give a shout out, man. For you guys that did not hear the announcement at the top, please stand by next week. Ryan Scribner is going to be offering our collaboration video. I drove up there 3.5 hours to do a joint collaboration before I cut out of here from Virginia. It's something I had to do before I got out of here, and I'm in debt to him, so keep your eyes open for that. I'm the one that offers the 6 dividend picks on that video, so I'm giving you guys kind of a preface, right, of that video that's going to be released sometime next week. I don't know when he's going to release it. He'll probably give me a heads up, but when he does, watch the hell out of it and share the hell out of it, please, because I would like to see if it's possible to own a channel that gets to 10,000 subscribers. Call me crazy, but that's where I see it going. I'd really like to get up to that 10,000 subscriber mark because our message is strong and it needs to get out there to the masses. It really does. How much of the portfolio should be in ETFs? It is absolutely relative, and it has to do with a lot of different factors, okay? And I always come back when anybody asks me a question like this. This is really a very, very good question, and I get it all the time, all right? But it really depends on your age, your risk tolerance. If you have existing other accounts, do you not have debt? Do you have a savings account built up, right? What type of investor do you want to be? Why are you investing, right? What are your financial goals in the future? Have you thought about that? Are you going to retire? The word retirement means something different to me, right? Guys like me don't retire. We continue to work until we're dead. It's just the difference is we define our work the way we want it later on in life. That's financial freedom to me. That's financial freedom and flexibility. If I want to flip a house, I can do it because I have the financial capital to do so. That's retirement to me, all right? But I put out your portfolio options in the Facebook group to identify that you can go 100% in VTI. If you wanted to put your portfolio on autopilot, invest the whole thing in the S&P 500 or a good total stock index like the VTI, and just put it on autopilot. You don't have to have any single stock exposure at all. What I mentioned on the Scribner video is the dividend payer from Vanguard, the VYM, is another good option. If you just want to invest in pieces of all the good dividend payers in the stock market, buy the VYM, sit on the 3% dividend for the rest of your life, and it's a good to go. That account can get you done as well, as long as it's housed in the right account. All right. But I set up portfolio options to say that, look, if you wanted a stock blend portfolio, which means it's weighted more to stock, so 75% of that portfolio is going to be weighted towards stocks, and 25% is going to be weighted toward a passive ETF. Where would that be appropriate? That would be appropriate if you had an existing 401k to where you said, you know what, Ryan, I've already got this passive baseline in place. I want to start a stock account, but I don't want to go 100% stock account. I want to have a little bit in VTI, put 25% in that. And guys, make no mistake, this game is about cutting up money to meet your goals. All right. I do a 50-50 blend portfolio where you take, let's say, $5,500, which is 1 year's of exposure, and you do 50% in the VTI or 50% in the VOO and 50% in stock. That's what we just built for my good friend Les, who's right below Baba, who the question I'm going to get to right next. That's what we did for him, is a 50-50 blend. And that's a beautiful product, depending on what other assets you have. All right. If you don't have any other assets, it may be a prudent move to just go 100% passive. Or if you wanted to get a little bit of stock exposure, do what I consider a passive stock portfolio, okay? Where the 75% is weighted toward a passive percentage. So 75% of the portfolio will go into VTI, and then just a small quarter of that portfolio will be devoted to single stock allocation. So I've covered the entire spectrum, okay? It really kind of just depends on what it comes down to, in that I'm not here to tell you that you have to have a 70-30, blend. I'm not here to tell you that. I'm here to provide you a way of strategically thinking about your portfolio. Now, you have two options as far as I'm concerned. If you want to add the bond option, you can do that. All right. Vanguard gives you really good options. I like BND with the ETF BND. It'll get you 7% per year in that bond fund if that's what you want to do. All right. And that's fine. I'm just not into bonds. Okay. It's not into the way I invest. It's not into the way that I think we need to be investing right now. Now, that may change. If the bond landscape starts to change, then you'll hear my tune change and adapt. And I will, trust me, you guys will be the first to know if we start to change our mentality in thinking that you need to seek shelter as opposed to being in equities right now. Okay. So if you're just waking up to the stock market right now, you need to be in the stock market. Okay. You need to be invested in stocks or ETFs. You invest in stock or the broader market, you're going to be totally fine. All right. Well, hopefully that answers your question there, Baba. That's a good question. If you need clarification or further on that, please don't hesitate to hit me up. All right. I've got Les on the line here. Hey, Ryan, at my Friday night commitment, but wanted to remind you that you are a rock star. Like I said, man, I'm not playing guitar tonight, man. I'm just talking. And I said at the top of the show, I do not have any makeup on. As you can see, I don't have a suit and tie either. Okay. And every now and then I do this to prove a point, right? Yep. I do that to prove a point, right? You do not have to sit behind an oak desk with a fake tree in the corner and try to sell people a bunch of crap. I think what you guys are going to benefit from is watching the Independent Investor channel and understand that I don't have an agenda. I don't. My agenda doesn't have to exist to get all of your money as assets under management in my brokerage house. Okay. That's not my agenda. All right. So that's why I can recommend to a lot of people, look, if you've got a little bit of cash on the side, man, that's a good thing. If it helps you sleep easy at night, right? Then that's a good thing. All right. Because my motives are different than the financial planners. The financial planners want to rake. They want to rake in as much assets under management. Now, I want to premise this. They've changed the lingo a little bit in the investment community, and they call it assets under care. All right. Assets under care. It's supposed to be a little softer. They must have came to this decision behind a closed room and thought that assets under management was way too scathing, because people are getting smart. They're getting hip to the procedure and understanding that the fees are just not worth the services rendered. All right. But I don't know about being a rock star, man. But like I said, no makeup and no suit. I'm probably providing more benefit, man, than 1,000 suits and ties. All right. Thank you for your help. Both accounts are fully funded and all stock bought. Thanks again. It's awesome, man. You know, I almost would have rather have seen a little bit of a pullback today. The stock market is fickle. I thought the stock market was going to go down. It actually went down over the night. It went down big with Macron, the French prime minister, right? Announced the big announcement that they were thinking about cutting the United States out of a big deal that they were trying to, and the stock market did not like that at all. Futures came back overnight, and we actually ended the Dow today a little bit up. So you may not have got the greatest entry points on those stocks, but the stocks that I recommended to you, every single one of them, for some reason or another, kind of provided a nice entry for you. All right. I did end up going and getting with Scribner, Les. So I'd like you to keep your ears open for that, please. I think you'll recognize some of those stocks. He allowed me to do the top 6 dividend stocks that I felt were, and we had a great discussion, man. I really think, hopefully, I don't know, his audience is a little different than mine. My audience is extremely loyal because people who want to be here and talk stocks or get a little bit of a stock opinion for an hour, let's say once a week, that they want the content. Okay. And I think when you have 250,000 subscribers on your channel, you tend to get a whole different host of personalities and motivations as to why they watch the channel. Okay. But I really hope the message is received. I'm a little nervous about how it's going to be received. I was happy with the content. I'm glad with how it went down, but we'll see how it shakes out. Hopefully it drops a big bomb on the Independent Investor channel. Hopefully I get a few thousand subscribers out of the deal. I told him that's not really why I went up there. And I'll let you guys in on a little secret. I actually went downtown Manhattan this week and got Scribner a bull, a real bull, a big one. So he doesn't have a baby bull anymore. He's actually got a big bull now. And I made that a gift, really, just as a token of my appreciation for all that he's done on the channel. I mean, guys probably given me more than I've given him. You know, I've given him a few gestures of my time and expertise, and I know he appreciated the heck out of that. But man, just an awesome individual, and I'm really excited about that content being released next week. So keep your eyes open, please. I'm going to scroll through here, guys. I'm going to try to keep this under an hour. I don't know how excited people are on getting on here and seeing me rant for an hour and a half. I usually go until I lose my voice. If anybody is wondering, I'm not drinking bourbon. I'm drinking green tea. That actually keeps me going through this whole thing. So thank you for allowing me the slight interruptions because, again, I lose my voice talking this much. You should try it sometime. It's interesting. So I'm going to kind of scour through here. Donald Duck doesn't. Good evening, Ryan. Me too. I agree with you. Yep. What's your take on SCHD for a leading ETF in your portfolio? Yeah, Alan. I mean, I would have to look at that. I don't. If you could give me a little bit more particulars, I certainly could ask you what the expense ratio is. That's something that I compare to. And if that particular product, if there's a comparable with Vanguard, with an equally comparable year-over-year performance, certainly would prefer a Vanguard product. But I will have to look at that. I don't have the specs in front of me. I could certainly look it up, and I don't want to take time away from the live feed. I'm a big fan of ETFs over index funds and mutual funds, no doubt. I love the freedom and flexibility. I love the fact that you can dividend reinvest within your retirement account. SCHD, if it's a low expense ratio, and I'm talking low, like below 15 basis points, it better be below 0.15% for me to advocate for that product and make sure that, again, if you were satisfied with the holdings within that ETF, that there's not a comparable Vanguard product out there on the market with lesser of an expense ratio, because those 0.1 of points, those make a big difference over time, right? 0.04 is going to cost you $7,000 over a 40-year cycle, right? So you double that at 0.08, and you can almost double that, and it kind of gets expensive, even just on the expense side, when you're talking about ETFs, even as low as Vanguard offers, all right? So that was a killer question. Thank you. I want to look into that a little bit after the live feed. I will look into it and kind of give you a better opinion about it. I can give that opinion to you in the Facebook group, certainly, but I don't have that ETF memorized. But those would be the two things I would look at: expense ratio, and then what type of holdings that actually covers. Doug's talking about 500 shares of Kronos today at $8.90. I don't know. You'll probably make $50,000 on it, Doug. I mean, this is common business for you, man. I don't know how you can turn these stock picks into gold, man. Bought some GE today. There, it'll probably double for you since you've got the touch of gold. I work with a guy who's got the touch of gold. Everything he buys goes up, man. I have to work a little bit harder than that. That's why I tend to stray a little bit more toward the value side of the house, because if I'm going to get rocked, I'm going to get rocked by stocks like Johnson & Johnson and Google, for crying out loud. I don't have quite the good hand as you do, but good luck on those trades, man. I hope they work out for you. I'm still a long-term holder of General Electric. I think that's going to be a doubler. I think a lot of people are going to regret not picking it up at $13, $14 a share. They've got way too much value there. Those are the same people that are buying Tesla that aren't buying GE. So I don't, go figure. I don't know. Tesla doesn't make a dime. So I don't understand it. Avi, this market is showing signs of irrational exuberance. Yeah, I call it euphoria. I couldn't agree more. Good time to focus on value. Last week, J&J at its 52-week lows was a great time to bring down my cost basis. I agree, 100%. I was actually very tempted today. I had to liquidate a couple positions to make room, but if J&J is still hovering, I'm going to beef up my existing holding. I think I've got around $3,000 of J&J. I don't know if that's 31 shares or 32, 33, 34 shares or something like that in J&J right now. I want to beef that up. I'll probably add another 20 shares to that position this week if it continues to hold right here. I did add to Procter & Gamble in the low 70s, and that's looking like it's going to work out really, really well. I mean, I would buy Procter at 96. Certainly going to buy it at 72. So it's just value investing, trying to get and monitor the stock so you get a favorable entry point into the stock. Okay, I couldn't agree more with you. I've got Mario Saros. Hi, Ryan. What is your view on Vanguard target retirement funds that have balanced asset allocation? Thank you for all your good work. Take care. From Scotland. Oh my gosh, man. Congratulations. You live in Scotland. That's amazing. I've only seen pictures of your country. I cannot wait to go there, man. I cannot wait. You're from a beautiful country, and thank you for what the hell time is it there, man? I can't believe you're tuning into a live feed from New York City, but thank you very much for your question. The targeted funds are interesting. We have something similar in our retirement accounts to where you can just put the money in there and it basically gives you a target date of 20, 30, 40, or 50 years till retirement, right? And you invest your dollars and it's automatically invested in a certain way, and it's built to adjust over time to be more aggressive at the front end of it and then kind of scale back on some of that exposure to risk as you get closer to your target date. I think it's a really, really safe autopilot way of investing. It diversifies you, no doubt about it. I tend to, like our program specifically takes already diversified assets and puts them into a pie and then just adjust those already diversified assets. So for example, initially, they may put you at 50% S&P 500 fund and then adjust that from 50% down to, let's say, 30%. And the rest of that pie will be filled in with more fixed income. I'm really not a fan of investing like that. I really think investing in, let's say, our S&P 500 here in the United States gives you nice diversification anyway. And if you were looking for more international exposure, certainly there are products that I recommend, one of my commenters up above already recommended or mentioned one of the total stock index funds that I recommend all the time, and that's the Vanguard's total stock index. And that also is offered to consumers at a very, very low expense. And I think if you bought into that fund, I think you would be doing just fine. You own exposure over 3,700 different stocks. I think the target funds are a good idea as long as you have a very, very low risk tolerance to the stock market. If you want a little bit more excitement than that, a little bit higher rate of return, okay? Excitement is emotion, so I hate to say that, but it would drive me up the wall to have a target fund, okay? It's not in my DNA to have a target fund in my portfolio, all right? My particular employer sponsored does have the target fund, but what I do own in there is 70% in the S&P 500, 15% in the small cap fund, and the remainder in an international fund. That's what I have. I have those 3 index funds, and that's diversified enough for me. Okay. I don't need to put that into a target fund date if I am already diversified in those. And I don't want to change my exposure to risk until I tell it to change. I don't want it to automatically adjust over time to get safer, because as it adjusts and gets safer, that might be the time that the market actually explodes and continues up. And here you are taking a scale back based on your age, when in fact the market is taking off. Now, I have a different idea of what I want for my retirement funds too, okay? I may never touch my retirement or my investment funds, okay? I've got a pension coming to me, and I've got retirement since my employment is with the military. So it's a little bit unique in that manner, okay? I don't have to rely so heavily on it. And I think the last thing I will say about those target date funds is if you have a lot of discretionary money and money's really not an issue for you, if you're making, a sizable amount, certainly you can take the safe route because you're already a winner, you're making good income, put it in the target date fund. It's going to be very safe for you. It's going to perform over time, and it's going to get you to realize your financial goals. That was an awesome question. Thank you very much, man. Very cool. Have fun in Scotland, man. I'll see you there someday. That's very cool. That's on my bucket list. We'll jump on J&J Monday. Yeah, I would. I mean, you're not that type of investor, Doug. I'd love to see you take some of these winnings and just kind of scale into some of these smaller positions. Some of these blue chips. You want to be a riskier investor, that's totally fine. But I'd like to see you with a little bit of pay dirt built up on the side in some of these blue chip companies that have done nothing but reward shareholders over time, man. It's just unbelievable how I think we saw that J&J has paid a dividend for over 100 years. It's one of the rare companies that actually has a AAA Moody's rating for their financial stewardship. That's unbelievable. It doesn't get any better. Complicated question. Oh, God. Oh, I'm sorry. I jumped over Bob real quick. I got Bob Goldcat right above that. The wife finally moved Roth out of Edward Jones. That's exactly what I did, to Vanguard. I've been a self-directed for 6 years now. That's awesome. You've been doing it just 1 year less than me. And that is about the time when it was being introduced to the market, and still nobody knows about it. Nobody. So we need to do our fair share in trying to get the word out there to people so they can also reap the rewards, because I can tell you this, I'm very intimate. I've done some videos in my archive. If you guys come across some of my older videos, man, I do one video that talks about a 43-page disclosure from Edward Jones. It is laughable. It is laughable what they put in that document, and they know that no one out there is going to read that document, but it is amazing what is actually contained within that 43 pages of disclosure from that company. It's amazing. And it's also amazing that people, I know they're not reading the disclosure, because the very first thing it says basically is, if you read the disclosure, you'll probably never invest with our firm. Now I'm paraphrasing, but that's really what it should say. An intelligent, informed investor should read and understand all of the particulars about our particular funds. Only an informed investor should invest with our firm. That's basically what it says, the very first sentence. And if you read through there, man, it's appalling. There's no wonder they have over $1 trillion of assets under management. Okay. Congratulations on your self-directed account. Now let's get to this complicated question. If China has acquired intellectual property from tech companies and then copying them for their domestic use, do these Chinese companies have the same, if not more value? I don't know. Probably. I think when I mentioned the intellectual the intellectual property theft, I was kind of talking more along the lines of the tariffs, and that's why I kind of reduced positions this week. Because I think if this thing goes from trade talks to trade wars, like it or not, we're going to get a hiccup in the stock market. There's one thing about the U.S. stock market that I've noticed over time is that sometimes it is an absolute sissy to bad news. It doesn't even have to be real. It can just be a tweet or a comment or somebody is having a bad day and saying the wrong thing, and the stock market will go down 500 bips for no reason. And it's looking for a reason to go down. So I don't know if it's hypersensitive right now, but I took the opportunity to take a little exposure off the table. But Alibaba is the best company that I see in China right now. I would put China Mobile up there as probably one of my worst trades of the year. Really. I mean, I entered into the position at just over 50, thought I was getting a really good entry point. At 13 times earnings, it's adjusted back to 11 times right now. And they make killer money. They're into 5G right now. It's just that the Chinese government controls everything that they do. So I'm looking to get probably positive in that telecom name and actually rotate out of it as soon as I can. So that's just what I'm doing. I'm making a 6.5% dividend in the meantime. So I've got Avi replying to Doug there. That's awesome. I appreciate that, you guys. Been added to my position in Crown as well. You guys got that going on, man. I don't know. I'd listen to Doug, man. He makes money in every stock he enters into. It's pretty cool. Tesla stock is a good buy, Ryan. No, I was being facetious. I don't invest in Tesla. I'm not saying you can't make money in Tesla, but investing in Tesla, I think, is not for me. And I don't expect it's going to be for you guys. Listen, if you hold, like I'm in a position to own Tesla, I choose not to. But new investors, why? Why do you want to invest in Tesla when you've got 100 other different companies out there? You certainly have a good top of the tier 10 stocks that you should be owning before you ever consider putting 5% of investment capital or aggressive capital toward owning a few shares of Tesla. There's no reason to do so. It's not an investment in my mind, and they don't make money, So no, I do not recommend Tesla on the Independent Investor channel. I think it's absurd to do so. It's not in line with any fundamental stock picking. It's not in line with any sound financial approach whatsoever. No way. So no, I'm not advocating for Tesla. Musk is a shyster, no doubt about it. I agree. I think the guy's an asshole, to be honest with you. He's a genius. No, he's a genius. I mean, no, the product is fantastic. Tesla's great. That's wonderful. But look, if you have to borrow money to burn more money and you can't make money, then maybe it's not working. I don't know. I actually think eventually Tesla will work. Okay. And all these investors, so-called investors who are just blindly investing in Tesla on blind faith, basically, will probably be rewarded. That's why I say that you could probably make money in Tesla. I didn't say that you couldn't make money. I just said that I will never invest in the company. I'm not interested in owning Tesla, not in the least. Let's scour through here. Doug's really active on this. Retirement to me is being on the beach buying my stocks. That's awesome. Everybody's got their own, man. It's different strokes for different folks, man. That's pretty cool. Pretty cool. I've got one. June fan 11. Ryan, which one do you think is better right now, Bank of America or Wells Fargo? Man, that's an awesome question. I've owned Wells Fargo for years. I bought a trading position in Bank of America this week. I sold it 2 days later. I made $100. I bought 100 shares. I just sold it because I own JP Morgan, I own Citigroup, and I own Wells Fargo, which I think all three of those are better than Bank of America. Bank of America is number 4 on that list. And it's actually probably the most intriguing out of that list of 4. I don't know if JP Morgan right here is dead money. Banks have been kind of out of favor for the last couple months. Financial sector exposure is something that you really just need to have in your portfolio. But if you don't have any Wells Fargo in your portfolio, that's number 1. Number 2 on that list is JP Morgan, the biggest bank in the world. Number 3 is Citigroup. That all 3 of those banks are premium to Bank of America, but Bank of America is up there as one of the largest banks in the world. They're a good product. At $30, there's a good entry point on B of A, and you could probably win. You pick B of A, you could probably outperform all those other 3. Okay, I'm not saying you can't make money with Bank of America. I would just rather see you go with Wells Fargo and pick up that nice fat 3% dividend. Okay, so that's what I'm looking at. We are worthy. I love it. Tim's on the line. I got Tim Tellers, man. Just wanted to give a shout out to you, Ryan. I'm always taking your advice. SCHD is 0.07. That's awesome. Thank you for looking that up for me. You guys understand I've got to keep one eye on the comments, and I've got to keep one eye kind of on the clock. I try to keep it in check a little bit. Otherwise, I just sit here and talk all night. And you guys really aren't into that. I'm trying to deliver as much value as I can, crammed into about just a little over an hour for you guys. 0.07 on that stock, on that ETF is actually very acceptable. That's the range we're looking to be in right there, guys. That's absolutely in range. So I've got another comeback there for the Schwab US dividend ETF. Yeah, that's really good, 0.07. I'd like to know, I think VYM is actually double that, if I'm not mistaken. But certainly if that's the comparable fund, I would look at VYM and compare it, look at its year-over-year performance, look at the dividend yield. If it's a dividend ETF, obviously it's probably around 3%. I take it. I'm just taking a small guess at it. But the VYM would be the comparable, and I think VYM is 0.14, I believe. So double that. So you need to make sure that the Schwab is a comparable product. I'd pick up Schwab before that. Okay, so that's a really good discussion right there. Please show your appreciation by hitting the like button. Yes, smash the like button. Right? Isn't that what you guys all say on YouTube? Smash the like button. I don't know. I don't know if I'll ever get to that polished approach, man, that some of those cats have on YouTube. But I could really care less. I don't care. I'm not going to change for anybody. I want to keep creative control of the Independent Investor channel. That's just the way it's going to be. That's one of those things I kind of insist on. So thank you for that. I really appreciate it. Man, I wish Tesla paid dividends. They're not going to pay a dividend. Had Solar City, but when they dissolved, they gave me 3 shares of Tesla. Ouch. Yeah, that sucks. Good grief. Yeah, that's too bad. Yeah, they're not going to pay a dividend. They don't make money. I mean, how are they going to pay a freaking dividend? They have to borrow money so they can waste their money. So we can get him into Mars. Just kidding, but not really. I mean, I don't know. I don't know what the hell that company does with their money. They make a hell of a car, I guess. I would never buy one. I would drive one for free. Again, if somebody wants to give me a Tesla, I'll take it. I'll drive it. But I'm not gonna pay $50,000 for a Tesla. Forget it. It's a waste of money. Ryan, enjoying the content, and early congrats on 4,000. I don't know, man. We could turn south and head back to 0. I don't know. We'll see. When I make sure we're not losing subscribers here, man. I don't know. Don't jinx it. So make sure we get to 4,000 this weekend. So, but thank you very much. If I would have started the channel last year and somebody would have said, hey, by this time next year you'd be at 4,000 subscribers, I would have been ecstatic with that. I love it. Scribner hit me up the day before yesterday when I went up there, and he's like, what are your goals for the channel? And I said, every day that goes by, I'm meeting a new goal. You know, the subscriber base is going up. I've got a very loyal following. I think guys are sharing it. I'm getting to talk with a few of my subscribers. It's very special to me. I'm learning a lot about what people need by pulsing in with people. So this is a two-way road, guys. Don't get me wrong. I'm not one of those guys that gets on here and thinks I need to talk down to people. I just think I need to get on here and talk to people. And quite frankly, to be more specific, I actually approach it to talk with people. Okay, and that's exactly what this does. When I get on there and I do a 6 or 7 or 8 or 10-minute unscripted YouTube video, it's just me talking to my GoPro. That's it. And that's a real one-sided message. This is a lot more interactive, and quite frankly, I enjoy it more. So hopefully you guys get, the benefit out of this discussion. Maybe you get a little bit out of it. Maybe you get a lot next week. I don't know. But I really, really appreciate all the interaction on these. And we're going to kind of wrap it up. I'm going to get to the end of this. Thank you for that. I really appreciate it. I much prefer GM to Tesla. Absolutely. I would take GM as a value play. I've got a little bit of a special heart for GM because I got a little Detroit in my blood for sure. But yeah, I'd take GM any day over Tesla. GM's a legitimate company, man. Tesla's legitimate, but they don't make any money. Thank you for your information, Ryan. I'm listening to you and the blue chips. You've opened my eyes. I hope so. You've got a real knack for picking stocks, man. But you want to leverage that and try to do both avenues. I think you'll succeed long-term over time by hedging your bet a little bit, by having some blue chips over here and then going ahead and continuing on with your stock picking and your trading avenue, because it's seemingly working for you. And hell, you're probably making yourself, with a little bit of wealth, and I'm all about that. If I can give you a little bit of an idea to help accelerate that for you, I'm all about it. That's what I'm about. That's great. VYM is 0.08. Yeah, so pretty comparable, I think. So I would look at the yield and I would look at the year-over-year performance. I think both of those are probably going to perform for you quite well. And in true independent investor style, I want to caveat whether or not you buy the Schwab ETF or the VYM with Vanguard, make sure you house that asset within the self-directed account, guys. It's the single, and I won't change in my message. I know there's a lot of people that may just unsubscribe to the channel because they're tired of me hitting on this point. Those are the people that do not understand the importance of that message. And you guys might hear it 100 times and still not understand why I continually harp on that. Because if you heard nothing else from my message and you took that right there for action, which I've had a ton of people hit me up and validate back to me that they understand and they've done that for themselves, you're a freaking winner. You are a winner, and you may not understand why, but I do my very, very best to validate why this is the very best way to invest in the stock market. Make no mistake about it, man. Very, very cool. Like a good burger, I go 80-20, 80% dividend paying blues and 20% growth. I love that, man. That's a great, great plan. And, if it makes sense for you, maybe you want to adjust it over time, or maybe you want to try to keep that allocation the same. I'm all about that, man. Like I've said many times, I'm addressing AVA. You can win 1,000 different ways. You could probably win an infinite number of ways in the stock market. It's so much different than going and gambling in a casino. Gambling, you'll ultimately lose. I think with the stock market, if you play by a couple of rules that I insist on, all right, you can win in an infinite number of ways. And that's probably just one example of a million different ways that you could reach your financial goals in the stock market by deploying some of the strategies we talk about, all right? We're talking about the upper echelon of investments. Guys, look at what we've talked about tonight. We've talked about single stock, blue chip stocks. We've talked about a few different companies that offer ETFs. We've talked about the brokerages that offer those ETFs. We've talked about expense ratios. We've talked about expense ratios below 0.10 expense, right? We've kept below 0.10. My crowd knows never, ever to pay an expense ratio that's not justified for basically owning a product. That's it. And that's the range that we want to be in, guys. That is the sweet spot. That is the absolute place where we can justify that type of expense to own such a beautiful product within a self-directed account, right? Good night, Marios. Thank you so much for the question, man. Hopefully that answered it for you. I'm going to hit down here. Great live, as always, always happy, tuned in, hit that like and smash that sub. Absolutely. Same great core message and great new information every week. Absolutely. We're not going to deviate from the message. It just kind of allows for a little bit of pulse of where I feel like the stock market is. We talked about tariffs. Buckle your seatbelt for next year, or next week, excuse me. I really want you guys to be cautiously optimistic on the stock market again. Okay. I don't want you to be being overly aggressive in buying into strength. Okay. There's no reason to do that. There's always other avenues about budget reduction, about increasing savings, right? While your assets are working over here. You don't need to always just looking to buy, because eventually when this market does correct, you'll be prepared in a manner to know that you looked at why you made those decisions before the stock market went down, right? And how you can take those adjusted down stocks and maybe add to them or exercise your right to hold while all the turmoil is going on, okay? Because as we talked about, I think right now there's way too much euphoria in the stock market right now, okay? This will be the last question I get to. Definitely join the active Facebook group if you haven't already. VYM and CSCHD follow different index. VYM is a high dividend. SCHD performed better, but the yield is lower. Awesome. That's great. Thank you very much for that. I'm going to end on that comment. That's really good, guys. That's why we get on here and talk. And if you don't know a whole lot about the stock market and you've entered into this particular live feed, it's really kind of awesome and encouraging to hear us having a discussion about the stock market and ETFs and different products and different ways of entering into the stock market. And we're just regular people, right? This is something that we're told every single day that we cannot do. And I'm here to blow that out of the water and really dissolve that notion away, because really that's not what people need to hear. They need to hear a message of empowerment. And I use that word all the time. And I want to make sure that you guys are empowered to realize that you can do it on your own. Guys, thanks a lot for tuning into this live feed. I'll probably do another live feed tomorrow. So if you're feeling feisty, we'll go ahead and we'll roll again. We'll do a live feed on Saturday, and hopefully we can change up the tone and the pace. Guys, thank you a lot for tuning in, and enjoy your weekend. Thanks a lot, guys.